conference is being recorded.
On an ongoing basis must be an arranged transaction. And of course, current economic conditions have not eliminated the need or desire for liquidity and succession. People operating companies still are interested in how, at some point, they can transfer their companies, how they can plan for liquidity and succession. But of course, it's become a little bit more difficult. And of course, there is no easy way to market time these events. Many things drive the desire for liquidity at a particular moment, and they may be very much unrelated to the company. They may be age, they may be company specific, they may be other circumstances. And generally the advice is what people ought to do ought to be based on what their goals are in the context of achievable alternatives. And of course, achievable alternatives may be an economic specific idea. What can be done today is different than what could be done 2 years ago, and may very well be different than what could be done 2 years from now. Of course, if we knew what could be done 2 years from now, we'd all be a lot smarter, wiser, and wealthier. And with that being said, if you ask people what is it that they want from a liquidity and succession process, of course, the first thing is how big is the check? And how much do I get to keep, which is how do I maximize my after-tax proceeds. Related to that, and equally important very often, is when will this happen? Will this happen sooner or later? For many companies, the privately held companies, they are really entrepreneur-driven, and most of these companies are founded by people for whom the company is not only an investment, but their livelihood. If you speak to most entrepreneurs in closely held companies, you will find that they did not create and build their companies using elaborate spreadsheets to estimate return on investment and to figure out exactly how much money they would make. They very often you'll hear more of a case of I needed a job or I had an opportunity and this looked like the thing to do. So you're not only talking typically with people about their role as an investor in a privately held company, you're often talking also about their ongoing role as an executive and as a key person in the company. And so therefore, timing not only from a financial point of view, but also from a career and livelihood point of view becomes very important in figuring out what to do with a privately held company. And of course, people are interested in diversifying their personal wealth. Many folks have many of their eggs in a single basket and wish to have more eggs in different baskets. And finally, of course, people may have a variety of other concerns about what happens to their company that is really unrelated to finance and timing. It's other things that people care about. They may care about the role of the company in an industry. They may care about the role of a company in a community. They may care deeply about the mission of the company. They may care very deeply about the people that work there and the opportunity for other key people who have helped build the company. And these different things can greatly influence what folks might want to do with their ownership interest in a privately held company. What do people worry about? Of course, family members are an issue. What's going to happen to the company? Will continue as an independent and identifiable enterprise. Can one really get oneself out of the ongoing responsibilities as an executive officer? In other words, will a liquidity process really drag along succession? How do I reward key people? And how finally do I sell the company without continuing to be on the hook? And with that, we can get to a pretty straightforward matrix of alternatives. We can look to the world of external buyers, which break out into the idea of the strategic buyer, people who see your company not as it is today with a certain composition of revenues and opportunities, but to see opportunities as it might be in combination with what the buyer brings to the table. And they may see strategic opportunities, see ways that 1 and 1 truly adds up to be 3, and therefore be willing to look at and perhaps pay a premium for the opportunity to own the company. Very commonly in the last few years, we've seen a proliferation of financial buyers. These are folks, the proverbial boys from New York, if you will, who are bringing money to the table and hoping that they will yield good cash flow as a return on their investment. They may have some quasi-strategic ideas. They may be trying to put together several companies in an industry. They may think they have particular management discipline or other skill as shareholders, but fundamentally they view the company as it is with the capacity to generate cash flow, and they're taking a view of what the expected cash flows might be and the risks of those cash flows occurring. And finally, some people consider eventually going public. This was much, much more common 10, 20 years ago. However, frankly, of all of the folks who told me that their end exit strategy was to go public, I've yet to see any of those as recognizable names on the stock exchange. So that's a much less common thing. And of course, the thresholds for doing this have gone up radically. For the world of internal buyers, people that are already involved with the company, this breaks down into family transfers, intergenerational wealth transfers or buyers, management buyouts, perhaps partner buy, sells, and so forth, and finally ESOPs. And of course, the last way out, if nothing else works, is liquidity. And let's look at now at how this current economy is affecting this. First of all, we have a question saying, what's the implication of using ESOPs in the current low valuation environment given recent market turmoil? We'll talk some more about valuation. I would say that as a practical result, I would not call the current valuation environment a low valuation environment for privately held companies. It's a practical matter. Privately held companies did not reflect nearly as much of what has turned out to be somewhat of a bubble and do not move as quickly downward as auction market valuations, stock exchange valuations, which are very much driven by short-term events. The survey data I've seen out there in the lower end of middle market, which looks simply at multiples of EBITDA as a valuation guide, says that average valuations for reported transactions between 5 and 25 million, I believe the data I saw, had moved down from an average of the low 6s to an average of the mid-high 5s. So there's probably a half a turn of EBITDA down in valuation, but not the kind of 30 and 40% declines we've seen in the public markets. But that being said, there are not right now many fewer third-party sales for cash. And that is because a lot of the private equity firms and so forth are on the sidelines. And so while the valuations of reported transactions may be staying up, it's much harder to get a third-party sale done. Many more of the buyers are strategic buyers making acquisitions within a particular industry or within a particular set of goals. And really the impact of tightening credit standards in the very tight credit market that we're in have impaired a little bit both price and terms of third-party transactions. Price because buyers can no longer obtain cheap capital to make the acquisition as easily as they used to, and terms because there's a much higher scrutiny when people are investing primarily their own money. And so what we see is generally a marketplace where there are fewer liquidity and succession transactions being done out there, but of course ESOPs as a percentage of those transactions rising dramatically. A few years ago it was very common to see people planning to do an ESOP transaction and perhaps stopping at some midpoint because somebody had rolled up with enough truckloads of $100 bills that they said the cash offer from the outside was overwhelmed any other considerations that might drive the ESOP transaction. And for better or worse, there's very little danger from of that happening right now. And so ESOPs are becoming an alternative for companies that might have a few years ago looked more actively to a third-party sale. And when we look at the world of internal buyers, of which ESOPs fit in, the idea here is we're going to use company cash flow to accomplish a purchase of stock from shareholders from a known inside party. And this can be any mixture of diversion of profit sharing and compensation, salary continuation, more commonly leveraged purchases by family management or ESOPs. And in the interest of time, I'm going to skip ahead a little bit and not focus so much on the next diagram, which looks at just what can happen to EBITDA generally, or on the slide concerning sale or gift to family members. But I think it's worthwhile to understand the differences and the opportunities between ESOPs and management buyouts. Because frankly, many of the companies that we see in a perfect world, the principals would sell the company to key management. Management is the most logical buyer. They know the company the best, and the most motivated buyer. They have the most to gain from buying and the most to lose if the company is sold somewhere else. Chronic problem of management buyouts is cash. Very few management teams have enough cash to make an all-cash or significant cash offer for the company. Very few companies have paid their management well enough to do this. And so management buyouts are typically leveraged. They use borrowed money. And on that basis, management buyouts tend to flounder on two problems: taxation and control. And from a taxation point, it's fairly easy to understand. Imagine we have a company with a fair value of $10 million. Selling shareholder expects to see $10 million. If we have a highly motivated management team that goes out and mortgages their houses, their children, their cars, and everything, borrows money from their brothers-in-law, and every place that they can raise cash, it will be a very high-performing management team if they're able to achieve $1 million of capital to invest. And if they achieve $1 million of capital to invest in a $10 million buyout, where that leaves them is $9 million short. And the problem with borrowing $9 million to fund a management buyout is, first of all, that you've got to pay it back. And if we have a company that is worth $10 million, chances are they're generating a couple of $1 million of cash. But if we're going to pay back in a management buyout $9 million, we're going to have to pay it back out of the after-tax dollars that we generate from the company. And so we can see pretty quickly that if the pre-tax dollars we need over time are $14 million, given effective tax rates, and we have to pay interest, the potential payback looks to be 20 years or longer. Secondly, no rational lender is going to lend a company $9 million in this current environment, or most environments, $9 million toward a $10 million buyout. 10% equity is not going to be enough, particularly given in most companies a lack of physical assets as collateral to support the loan. And so typically a selling shareholder is going to have to take back a rather large slug of paper in this hypothetical transaction. And of course, even if that is acceptable in general to the seller, there's often going to be a great debate over what's going to happen in terms of control over the company. From the point of view of a seller holding a very large piece of continued investment in the form of a seller note, what do they want most? They want adult supervision. And of course, what does management want? Having invested every dime they can scrape together, they want to be able to decide how to do things on their own way and on their own basis. So therefore, there's really very few management buyouts, particularly on a leveraged basis, of companies with significant value. They happen most often when management has an unusually large amount or access to capital, or the seller, for good or bad reasons, is highly motivated to sell it to the management team and willing to make great concessions in terms of price and control. We can do this as non-leveraged management buyouts. We can simply have people our management team buy a piece of the company each year, perhaps with some bonus money or what have you. But again, this tends not to be a terribly useful strategy for the long run because we don't get to buy enough stock fast enough. And if the company value is growing up, in fact, management is falling behind in terms of how they are buying the company. And we have the same basic tax inefficiencies. Management has got to earn a buck to develop 60 cents. And when they pay 60 cents for stock, if they pay it to a shareholder and the shareholder is taxed, we have very nicely turned $1 of corporate income into perhaps 40 some odd cents in the hands of a selling shareholder. Or in other words, we've made the government the more than 50% partner in our business. So these are reasons why management buyouts, however desirable in theory or concept, very rarely get exercised in practice. When we move along, we'll pass through. Redemptions and buy-sells have a lot of the same issues. And we're going to talk about ESOPs as an internal buyer for the rest of our session here. And the good part or good news about ESOPs are that they are tax efficient. We'll see how we can use pre-tax dollars to fund our ESOP transition process. It's a shareholder-directed process where the good and the bad is that individuals are not typically investing money directly, so key shareholders tend to be able to focus the process and run the process. Downsides of ESOPs, which we will talk about, are first and foremost, they are complex. They function with a great deal of attention to rules and details. They're hard to explain, hard to understand. You need to be spending time on webcasts like this to learn more about them. And they are regulated. We have the Department of Labor and the Internal Revenue Service potentially as reviewers and auditors of ESOP transactions. Stop for a second. We're going to talk now much more extensively about ESOPs. Any questions on the introductory pieces so far? You can throw in chat questions to do that. And with that, we'll move on to ESOPs. And the first and basics are ESOPs are employee stock ownership plans. They are qualified deferred compensation plans under ERISA and the Internal Revenue Code. Qualified plan means that we get the most basic tax break under the code. We can fund a retirement plan with pre-tax dollars as an employer, and the employees do not recognize taxation until they receive some distribution from the plan. ESOPs are broadly similar to profit sharing and 401k plans. Many of the rules you may love or loathe about eligibility, vesting, and the like apply equally to ESOPs. ESOPs, however, of course, are unique in two significant ways from all other forms of retirement plans. First of all, unlike conventional retirement plans, which are designed to invest in a diversified portfolio of assets, or required, in fact, to be diversified, ESOPs are designed to invest primarily in a single asset class, company stock. So the typical balance sheet of an ESOP plan may, in fact, be only company stock. And secondly, uniquely from other retirement plans, ESOPs can be leveraged. They can borrow money. So instead of simply taking on contributions on an ongoing basis and investing them, an ESOP can purchase a block of company stock up front and can use future company contributions and future dividends and distributions on the stock to repay the acquisition debt. I'm going to stop briefly for a question. Somebody has asked whether, in fact, LLCs are an efficient host, tax-efficient host for an ESOP, and the answer, unfortunately, is no. And the reason we say no is because an ESOP cannot hold an LLC interest. Employee stock ownership implies ownership of stock of a C corporation or an S corporation. So we move on and we say, what are people typically trying to do when they propose and execute ESOP transactions? First and foremost, shareholder liquidity. This tends to drag along the idea of succession. We're also, of course, looking at corporate and personal tax planning, and we're looking at an ownership/partnership kind of incentive, particularly for key employees and for employees broadly. Now, the first piece that tends to get people interested and focused on ESOPs are some of the tax preferences. These are what make the economics of ESOPs feasible and attractive. And there's four key tax advantages for ESOPs as a transaction device for liquidity. First of all, as we've referenced before, we have the ability to borrow money to fund an ESOP transaction, and with pre-tax dollars, which is to say we will get, as we'll show later on, effectively a deduction for the principal we're going to repay on an ESOP loan. So instead of, in our hypothetical $10 million transaction, borrowing $9 million, instead of having to earn $14 million to repay $9 million, we only have to earn $9 million to repay $9 million. So we have a tax efficiency in our finance structure. Secondly, we'll talk in a minute in more detail, we have an opportunity for shareholders of a C corporation to indefinitely defer capital gains tax on the sale of shares to an ESOP. Thirdly, we've got the ability to fund our ESOP not only with pension contributions that are tax deductible, but also with dividends on C corporation ESOP shares that are tax deductible. And we'll talk about how that works in a few minutes and why that's important. And fourthly, we have the huge advantage of being able to have an ESOP as a shareholder in an S corporation where the ESOP does not recognize income, taxable income, on its attributable share of corporate income. We'll talk about how that works in just a moment. First of all, capital gains deferral for ESOPs. The idea here is that a shareholder who sells stock to an ESOP, where the corporation is or becomes a C corporation on the date of sale, can indefinitely defer capital gains tax on the sale of shares. Major criteria for this is that the ESOP has to own at least 30% of the value of all company stock prior, as a result or after the sale. It doesn't have to be a 30% sale, but the ESOP has to own at least 30% after the sale is completed. And secondly, the selling shareholders have to purchase what is called qualified replacement property, QRP, which are stocks or bonds of any domestic operating corporation. Keywords are domestic and operating here. Corporation has to be a U.S. corporation, so foreign-based or foreign-incorporated companies are not eligible. And secondly, we have to be an operating corporation, meaning our income has to come from the operation of a trade or business. This covers most companies, but certain companies like, for instance, GE at times, where they make more of their money from their finance unit, or Dell at certain times when they had more investment income than they had income from selling PCs, don't necessarily qualify. So you need somebody to run a good screen on what is qualified replacement property. What is a domestic operating corporation? There are also some more sophisticated techniques here, which we will not cover, using more sophisticated investments to defer capital gains tax. But the basic idea here is the opportunity in a C corporation to get the equivalent of a like-kind exchange. It's not coincidental that Section 1042 is located in the same general neighborhood of the code as 1031, which is like-kind exchange for real estate, in that what we're really doing is exchanging our investment in a closely held company for an investment in another company and being able to avoid paying taxes on that sale and replacement of the investment. Second thing we'll cover here as a key tax attribute is the idea of an S corporation ESOP. And of course, in an S corporation, income is attributed to shareholders for tax purposes. The ESOP, as an S corporation shareholder, does not pay any taxes on its share of corporate income. So if you follow this out, Lodge, we have a company where the ESOP owns 100% of the shares, and the shareholder has elected for the company to be taxed as an S corporation. We have reached a form of tax nirvana. The corporation does not pay taxes because we're an S corporation, and the only shareholder of the corporation is a non-tax-paying entity. So we have essentially the ability to retain 100% of our earnings without paying the tax man at either the corporate or the individual level. Price of this benefit, key price is that in an S corporation, we cannot make a sale to an ESOP and defer capital gains. Someone's asked a question about the replacement being dollar for dollar. Yes, the measurement is proceeds received and reinvested. So if we sell in a transaction $10 million, if we want to defer capital gains tax on that $10 million sale, we have to buy $10 million of qualified replacement property. We could, of course, defer a lesser amount. We could buy $5 million of qualified replacement property and pay taxes on the other $5 million of proceeds. And by the way, there is a recognition of the deferred tax when we sell the qualified replacement property down the line. So we'll talk a bit now about how ESOPs work, first in words and then probably more usefully in pictures. And the idea here is that the company is going to create the ESOP as an entity. It is a trust for the benefit of employees. We do this the same way we would create any other kind of employee benefit. This trust is then typically going to purchase company stock, either from the shareholders or from the company. The financing for the transaction typically is going to come either from a bank or perhaps from the selling shareholder. On an ongoing basis, the company is going to make contributions or pay dividends to the ESOP, and the ESOP is going to use that to repay the financing it incurred to purchase stock. And finally, down the road, of course, the stock that's held by the ESOP, the company or the ESOP is going to have to repurchase it from employees at a point after employees leave the company. This is what we typically call the repurchase obligation. Someone's asked about the qualified replacement property play, aka 1042, is only for C corporation ESOPs. The answer for that is yes. If we are an S corporation, by the way, we can become a C corporation on any given date. Problem is, of course, we have to stay a C corporation for 5 years. But if we are an S corporation, that doesn't mean we are out of the discussion for all time. We're out of it as long as we remain an S corporation. So if we look at typically what we think of as an initial C corporation ESOP transaction, and what we're going to talk about here is a minority interest sale to the ESOP. And this is a company that is a C corporation or as an S corporation and elects to become a C corporation. My side comment here is that most, if not almost all of the time, a company that is considering a minority interest sale to an ESOP will decide to become a C corporation. It may be counterintuitive. We'll talk about some of the reasons in a minute. Someone asked, by the way, how does it work if the company is a C corporation and then elects S later on? Do you still get 1042 capital gains benefit, deferral benefit? And the answer is yes. The measurement of whether we're eligible for 1042 is our tax status on the date of the sale. Doesn't matter where we were the day before or where we end up the day after. And that's the related question of if we're a C corporation today, we can do a C corporation transaction perhaps on December 31, and we can elect to be an S corporation on January 1, and we haven't done anything to impair our ability to elect capital gains deferral. So typically, let's imagine our company here is worth $10 million. And by the way, how do we know it's worth $10 million? There is a requirement in all ESOP transactions that the ESOP have a financial advisor that does an independent appraisal of the value of company stocks. So ESOPs are not Priceline. We don't get to name our own price. There's an independent appraisal process on behalf of the ESOP. And imagine our appraiser has said, or we think the appraiser will say that the company is worth $10 million. And the demographics of an initial minority interest transaction are typically shareholders, entrepreneurs in the 45 to 60-year-old range who are basically saying that they would like to take some chips off the table. They'd like to get some liquidity, but they're really not ready for a change of control. They really see a second play. They're not sure whether they want to eventually necessarily sell the company to an ESOP or maybe sell it to somebody else, but they'd like to see the employees share in some of the ownership now, and they'd like to get some cash out now. So imagine in our $10 million value company, our shareholders want to plan and organize a $4 million ESOP transaction, a liquidity event. First thing they're going to typically want to do is look to borrow $4 million. And so our bank will typically be asked to provide $4 million of financing. And our company will give back in exchange for that financing a note, a promise to pay the bank back, and collateral, things the bank can grab and sell that the bank thinks are worth $4 million in the event of default. And of course, we're assuming a normal lending environment here, and to some extent we do have somewhat of a lending environment, albeit normal lending environment, albeit with very tight standards, which is to say we continue to see banks lending money when cash flows and collateral support the loan. And we'll talk about the lending environment a little bit later. But imagine now our company has borrowed $4 million from the bank. We'll also talk in a minute, what do we do if the company doesn't have $4 million of collateral? Imagine we're an engineering firm. Imagine we're a insurance brokerage. Imagine we're one of the many firms out there that generates lots of cash flow but doesn't have a lot of assets. We'll talk about how those companies go about doing these deals in a moment. So our company now has $4 million of cash in our first stage here, and has a liability for $4 million payable to the bank. Company is going to turn around and make typically what we call a mirror loan or an internal loan to the ESOP. And it's going to hand the cash to this trust created on behalf of employees, and it's going to receive back from the ESOP a note. The ESOP's promised to pay the company back, and a pledge of the stock the ESOP is going to buy with the proceeds of the cash. So from the company's point of view, it's borrowed $4 million and gotten $4 million of cash. It's turned around and lent $4 million and gotten a note back from the ESOP. We would like to believe from an accounting point of view that this balances out, that our liability to the bank is balanced out by our loan receivable from the ESOP. Unfortunately, under SOP 93-6, which is the accounting standard for ESOPs, we don't get that seemingly common sense tax treatment. That standard says that when we loan money to an ESOP, we don't book this as a loan receivable. We book it as a contra equity account, a hit to our equity section, on the theory that the only way the ESOP is going to get cash to pay us back is if we give it the cash. Net result, company balance sheet is going to look a little bit ugly after we do an ESOP transaction. Most but not all of the time we don't care. Most of the time the only people looking at our balance sheet from a credit and analytic point of view is the bank, and they're going to understand this transaction. The exceptions very often are companies like construction companies which have bonding requirements, or distributors where the manufacturers may be scrutinizing the balance sheet. There's a subset of companies that do have reporting to third parties where they're going to have to explain much more carefully the balance sheet effect of the ESOP. Someone has asked, why are we going through this borrowing and reloaning process? Why don't we simply borrow the money directly from the bank? And there's a couple of problems. One is banks will loan directly to ESOPs only if the company provides a guarantee. Why is that? The ESOP doesn't have any assets. Banks will not loan to the ESOP because ESOP doesn't have direct cash flow, because it doesn't own anything other than stock, and it doesn't have any assets. So they're going to want a company guarantee. And the next question is, why don't we have the bank loan to the ESOP with a company guarantee? And in fact, this is the way things happened very much in the 70s and the 80s. This stopped for a number of reasons. First of all, banks do like to loan directly where the collateral is. They worry in a guarantee situation about executing on the guarantee and whether there are some technical fraudulent conveyance issues in the transaction. Secondly, from the company point of view, we like the idea of being able to figure out how fast we pay back the bank in a way that may be disconnected with how fast we fund the ESOP. We may want to, inside of the ESOP, allocate stock and get tax deductions faster or slower than the rate at which we pay back the bank. So pretty uniformly now, these transactions are done as loans to the company with an internal loan to the ESOP. So our ESOP has $4 million of cash, and it is going to pay that cash over to shareholders in exchange for $4 million of stock. And here's where we get to an interesting piece, which is in a minority interest transaction that we're looking at here. The question is, how much stock does the ESOP get? We'd like to believe that since $4 million is 40% of $10 million, that the ESOP is getting 40% of the company. But in reality, if we talk to independent appraisers, they are typically going to tell us that there really ought to be a 20% minority interest discount. And if we have that kind of a minority interest discount, the ESOP really ought to be getting closer to 49% of the company for $4 million. Well, it's going to be a pretty unpopular proposition for most shareholders to say, let's take half of our $10 million value company and sell it for only 40% of $10 million. That will not attract many people to this. This is where tax-deductible dividends come into play in a very important way. Remembering that the way these deals are going to get funded, and I'm moving to the next slide for a minute here, the company is going to be making loan payments to the bank or the shareholders. If we imagine a $4 million loan over 7 years, our annual principal is going to be somewhere in the realm of $575,000. Maybe we'll have a couple $100,000 of interest. And as we know, the interest is tax deductible. The principal directly paid to the bank is not. However, at the same time, we're going to be funding our ESOP. And we're going to be funding our ESOP either with contributions, a tax-deductible compensation expense, or in a C corporation environment, perhaps with dividends. Dividends being tax-deductible to the company if they're paid to the ESOP and used by the ESOP to make loan payments back to the company. And so from the company point of view, we know we've got to fund the ESOP. And by the way, while it looks like the money is leaving the house twice, we're paying back the bank and we're making the payment to the ESOP, remember that when we hand the ESOP money, it's going to turn around and pay it back to the company. This is essentially a paper transaction because the ESOP owes the company $4 million. The important aspect here is when the company hands the ESOP money, it gets a tax deduction. And when the ESOP hands the money back to the company does not recognize income on the return of principal. So the payment to the ESOP and back to the company generates a tax deduction equivalent to the principal paid by the company to the bank. So when we say principal is tax deductible in an ESOP transaction, this is how it's happening. We're basically matching a cash non-deductible principal payment to the bank with effectively a non-cash deduction created by funding the ESOP and having the ESOP pay money back to the company. So given that we're indifferent to some degree with some particular aspects we won't discuss right now about whether the company hands the ESOP money labeled contribution tax deductibly or money labeled a dividend tax deductible, we now see a solution to our valuation dilemma on our prior page. And the solution is that we're going to sell to the ESOP a class of stock that has a right to a special dividend. We know the ESOP will use the dividend to repay its debt, but we also know that our same independent appraiser, who was probably very anxious to impose a minority discount on our sale of shares to the ESOP, is likely to view the shares as much more valuable because they have a right to a dividend stream. They are a preferred or super common stock. And typically the value of the dividend is going to offset our minority interest discount, and we typically are going to see in our $10 million company here essentially a $4 million transaction resulting in 40% of the company being transferred. And by the way, this use of the tax-deductible dividend to structure the ESOP stock and the repayment of debt is why most S corporations considering minority interest ESOPs become C corporations. Because of course, while capital gains deferral may be nice, at 15%, it doesn't drive the train necessarily, but this valuation advantage does. And that's why a lot of S corporations consider becoming C corporations for purposes of a minority ESOP transaction. So our shareholders have received $4 million, and we know because we are a C corporation here, if they take that $4 million and buy stocks of or bonds of any domestic operating corporation, what we call qualified replacement property, they can indefinitely defer capital gains tax on the transaction. And if they do so, very often there may be a negotiation with the bank over a pledge of some or all of that qualified replacement property as additional collateral. So if we're an engineering firm, for instance, that doesn't have a lot of collateral and a lot of ability to secure a loan, this may be our inducement to the bank to make the loan, to offer them a pledge. And this is, by the way, the most highly negotiated aspect of ESOP financing, of whether there will be a pledge of QRP, and if so, how much it will be. So that's our typical C corporation ESOP. And we move on and we talk a little bit about S corporation ESOPs. And in the world of S corporation ESOPs, I apologize, I'm going a little too fast here. In the world of S corporation ESOPs, very often we're seeing companies try to go from no ESOP ownership or small ESOP ownership to 100% ESOP ownership, perhaps in one fell swoop. And the idea here is we really want to get to that fundamental advantage of being 100% owned by the ESOP and therefore having a company that doesn't pay any taxes owned by a shareholder that doesn't pay any taxes. And again, let's imagine our $10 million transaction here. And in this case, we're again going to try and borrow whatever the bank will lend us. Maybe they'll lend us $4 million, and we'll give the bank note collateral, repay the $4 million. Of course, that leaves us about $6 million short in our potential ESOP transaction. In this case, we're probably going to redeem the shares from shareholders. We may have them sell them to the ESOP. It doesn't really matter. From the shareholder point of view, it's still a capital gains event, and we're not deferring it because we're an S corporation. And we're going to pay the shareholders whatever cash we've borrowed from the bank. In this case, we're guessing at $4 million. And we're going to give the shareholders a subordinated $6 million note for the balance. And once we've done that, we're going to give the stock of the company to the ESOP in exchange for a note so that we can allocate the stock to employees over a long period of time. And so the threshold question here is, why in heck would shareholders sell their company for some cash and a big note? One of the things that most people do not want to do when they sell their companies. But we have to remember why it is that people don't like to sell their companies for notes. The key reasons are the notes are typically lousy instruments. They have a low rate of interest. They have a high rate of risk, and we're giving up all of the control of the company to somebody and depending on somebody else to pay us back. And in this ESOP transaction, we can solve those problems. First of all, we're going to focus on giving the shareholders a market rate of return on their subordinated note. And market rate of return is governed by what it costs to get subordinated debt from a third-party provider. Subordinated debt investors and smaller companies expect a total return of 10, 12, 14, 16% on their money. And the way we're going to give that return is by paying a little bit of cash interest on the ongoing basis, perhaps 4, 5, 6%, but we are going to give our selling shareholders, in addition to that, warrants, which are equivalent to stock options, which are basically a right to the future upside of the company. Of course, the warrants are going to be pegged to the after debt value of the company, and the after debt value of the company is quite small. And commonly we'll see 15, 20% of the value of the company given in a warrant to shareholders as part of the subordinated note to give them an additional return for having basically taken subordinated debt in the company. And of course this warrant's very valuable. It is, the company's value is highly likely to grow from the very low value post-transaction. It's highly likely to grow because as it pays back debt, the value will grow. And of course, a company that's not paying any taxes can pay back debt much more quickly and grow much more quickly. And not only that, but the warrants, when finally cashed out, are primarily a capital gains event. There's some ordinary income mixed into all of this under some fairly complicated accounting rules and tax rules, but in the main, the warrant will be a capital gain event. So we're getting essentially 2 bites of the apple. We're getting the note, but then we're getting a piece of the upside in the future. So we've solved one of the issues a selling shareholder might have, which is, why should I take a much lower return on a note than I would have if I was continuing to hold the stock? The other issue the shareholder may have is about control over the company. And typically in the subordinated note, we are embedding control features that say to the company and to the ESOP, that the people who are holding the large part of the capital structure, the shareholders holding the note, are going to be able to control certain aspects of the company, including primarily who can be nominated to the board of directors, at least until the debt is repaid or substantially repaid. And of course the speech is if you want rid of us, pay us off. Go find the money to pay out the note in full. So this is typically how these kinds of 0 to 100% transactions are being done in a way that's attractive to selling shareholders. What's the attraction to the ESOP given all of these terms? It's buying the company with non-recourse debt. It's operating tax-free. It has a great chance to pay off all of this debt and have a tremendous return on investment as a result. Employees can make a lot of money this way. So this is really a win-win situation being done primarily through the tax arbitrage of having 40% of our income available that used to be going to the government. So typically, one vision people have is doing one or several 1042 transactions to get a lot of ownership into the ESOP over perhaps a long period of time. We may be in the interim using synthetic equity like stock appreciation rights or phantom stock to give key executives a stake in the company. And down the road at some point we're doing an S corporation election to be a tax-free entity, but that's fairly far off. And the alternate vision is to do it all at once, redemption or purchase of all of the shares, warrants to the selling shareholders, synthetic equity to key executives to give them a stake in the game, and using our S-Corp status to operate tax-free to accelerate debt reduction and to prosper. Typical concerns in getting a transaction done: valuation, financing, how the ESOP fits into the benefits structure, making sure we manage legal and fiduciary risk, and of course, cost and complexity. Talk for a minute about valuation in the current environment. Of course, valuation's got to be done by an independent appraiser on behalf of the ESOP. Usually our approach is to work on behalf of companies to understand how valuation is done and to do a company-side valuation and make that as a proposal to the independent appraiser rather than letting them proceed blind on their own behalf. Valuation's based on cash flows, typically, financial buyer perspective. We can't value strategic advantages we don't have. We'll, of course, deal with minority discounts or control premiums as appropriate. We'll have a marketability discount, and as we talked about before, we'll use dividend-paying stock as a way to manage valuation in a minority interest environment. And the back of the envelope way to approach this is to look at the total invested capital of the company, which is a multiple of EBITDA, earnings before interest, taxes, depreciation, and amort. And based on that multiple of EBITDA, we will subtract outstanding debt, and we'll also add back in assets that the enterprise has that they don't use in the business. Things like cash value of life insurance is a typical one. And of course, multiples of EBITDA, typical transaction multiples in the last year or so have been in the 5.5 to 6 range. There are lots of reasons why it can be higher or lower based on particular industry considerations, particular growth opportunities, how working capital feeds in, what the underlying asset base is, all the things that make valuations move from a back of an envelope to a more substantial and considered analysis. And as we said, we're down. Multiples are down, but they're not down in that. They're not dramatically down. Someone's asking about leveraged ESOPs in a construction company where the surety already has a first claim on collateral. For better or worse, there are a lot of ESOPs in the construction industry. And usually the issue is a mixture of finance. There may be more seller financing involved in a construction industry business because of the claims of a surety or the concerns of a surety. And the second is, of course, we're going to need the surety's consent. And of course, this depends on the particular company and the particular environment, but this is done very commonly. There are a lot of construction company ESOPs. It's a very natural piece of the process. Someone asks if your company has an ESOP, are they able to put more money into qualified plans than companies without an ESOP? And the answer is maybe. There are some enhanced limits for contributions, and we can use dividends. There is an overall limit, I believe it's $46,000 per employee of how much we can do into all kinds of deferred plans, but that ignores dividends. In other words, if the goal is simply to fund employee benefits at the highest possible level, an ESOP will increase the level of potential funding. Talk a minute about financing here. Keys are cash flow and collateral. They always have been. They probably always will be. Collateral is particularly a key concern in service firms. You also do want to look at making sure you don't use short-term assets such as receivables to finance long-term debts. These days, lenders are looking for minimum debt service coverages pretty close to 1.5 to 1. Debt service coverage being the projected EBITDA in relationship to principal and interest to be paid. In some cases, these ratios are even increasing. Right now, lenders are also focused on total debt in relationship to EBITDA, and that's probably the high end of debt packages from lenders now is probably closer to 2.5 to 1. Used to be 3.5 to 1 about 18 months ago. There is some play around working capital here. There are some companies that have very high levels of working capital financing that they turn fairly quickly. There really isn't much in the way of airballs out there right now. Lenders are really focused on fully collateralized lending. Again, 18 months ago, you could have airballs that were fairly significant, not in the current market. Rates are also up right now. LIBOR-based rates, which were as low as LIBOR plus 100 or 110 18 months ago, are now LIBOR plus 250 to 300. There still is a premium for fixed rates. We're also seeing some more floor rates out there, which says no matter how much LIBOR drops. And of course, we see lenders with existing debt very often trying to reprice it, trying to get more yield out of it. We're going to get our money from banks, maybe brokerage houses as well, also doing some lending, seller financing, and perhaps specialty finance groups. ESOP design, I'm going to skip over for the moment. I'm happy to talk to anybody more particularly if this is a focus. Let's talk quickly about the steps in getting an ESOP transaction done. First and foremost, companies will usually do some sort of a feasibility or transaction study. Goal here is not to figure out whether an ESOP can be done. It usually can, but whether or not it makes any sense, whether or not the mixture of valuation, finance, shareholder goals, and structure fit together in a way that is desirable. Secondly, we're then going to focus on financing. Where's the money going to come from? We're going to focus on the independent appraisal. Does our independent appraiser agree with the company and the shareholder view of value? We're going to focus on designing our plan. We're then going to put together transaction documents to reflect all of the agreements we may be making, and that will hopefully get us to a closing where one signs many, many, many documents, and hopefully at the end of the day there's a large check or wire to the shareholders in consideration for shares. Only governmental approval we've got in this process is typically post-closing. We're going to file our plan document with the IRS. This is a pro forma approval. The way the government looks at ESOPs is they don't really review transactions by a filing or by any kind of normal review process. They do things on audit. So the Department of Labor or the IRS will come in from time to time and audit ESOPs and make sure that things have been done properly. We worry about an ongoing basis. We have to update our appraisal annually. We've got to deal with record keeping and administration. Repurchase obligations may be of concern. Communications, training, and education may be of concern. And the government every few years passes what we consider to be a Lawyers Relief Act, in which they change the laws a little bit, and we have to amend our plans a little bit. Let me take a couple of questions here at the end. First of all, somebody asked, does the annual appraisal translate to an annual evaluation? That's the answer is yes. We have evaluation as of the end of each plan year. Secondly, somebody asks about fees. Fees are really a function of size and complexity. To give you the examples in the transaction sizes we were illustrating here, if we are doing a $3-4 million minority in transaction, typically we will not have an independent fiduciary at that size of transaction. Typical fees to get a plan created and a transaction done all in between ourselves and an independent appraiser will typically be in the $60,000, $70,000, $80,000 range. It may be lower if the transaction is smaller or more simple, and of course it can always be higher if it's larger and more complex. If we deal with change of control transactions that are larger, we do our $10 million S transaction, and we add on to our costs here both complexity, and we also add on independent fiduciary and probably an independent legal advisor, and we probably add another $50,000 to $100,000 of costs all in. These numbers are very, very ballpark because it's very company and situation specific. Ongoing costs are a little bit simpler. Typically, for companies with between 50 and 200 participants, one can expect annual appraisal and annual record keeping to be somewhere between $10,000 and $20,000, depending on number of people, size of transaction, who's doing the appraisal, so forth. Someone else asks, how quickly can ESOP expect to need cash for repurchase obligations? Typically, repurchase obligations don't tend to emerge in a significant way until 10 to 15 years out, and that's because the mixture of having the shares be allocated, having them become invested, having people leave the company, and then be entitled to a distribution takes a while. Remember, our basic distribution rules at the maximums, which we usually recommend, tell us that people get paid their account balances over a 5-year period, beginning either 1 year following death, disability, retirement, or 5 years following termination of employment. So typically you have about 10 years, 12 years before you're looking at significant repurchase obligations. I want to thank everybody for sitting through an hour on the phone. I've got one more question here. Over what time period are transaction costs paid out? And the answer is months. It's typically over the period of time that things happen. And last question is, what are things that go wrong with ESOPs? Why do ESOPs go bad? Who are the people that wish they never sat on a session like this and drank the Kool-Aid and did this? First of all, companies that don't do well with ESOPs are several kinds of companies. First are companies that really don't have any real affinity for employee ownership. If this is purely being done to move money in pieces around, it may work on that basis. It may work on a tax and finance basis, but these are companies that tend to then resent the idea that, gee, eventually employees have to get something from this. This is designed to be an employee benefit. Second things that go wrong are poorly organized, poorly structured, poorly executed transactions done by people who either are ignorant of or unwilling to follow the laws and regulations that apply. In other words, trying to do things with people who don't have experience with ESOPs and who do a poor job of them will lead you to bad transactions. Doing overly aggressive transactions in highly cyclical companies will also be a problem. You know, taking a company and valuing it on the basis of its outlying best year ever in a cyclical business is likely to get you in trouble if you do a leverage transaction and the performance isn't sustainable. And the fourth thing are people doing transactions they don't understand, which is particularly companies that don't have reasonably sophisticated people or people who spend time internally understanding the ESOP, executing a transaction under the advice of even the best of advisors may find that they haven't done something that met their goals because they didn't understand it terribly well, and they have trouble administering it and keeping it up because they don't understand it very well. A good example to me, a company I think about as if I picked one ESOP I wished I didn't do, was about 10, 15 years ago, a company with about 40 people, job shop, machine shop, key owner entrepreneur who understood it pretty well, didn't have successor management, had a bookkeeper rather than even a controller, and so he had one person who sort of understood it, and as soon as he wanted to be less involved, there really wasn't anybody who understood even the basics of this well enough to be effective with this. And that's a good example of a company that was too small for a complicated approach of an ESOP, and an ESOP is a complicated approach. Again, thanks people for patiently listening. Happy to take any more questions or comments offline. Feel free to call, email, or follow up in any way that would be helpful to you. And so I'm signing off, and everybody have a great day. Thank you. Bye-bye.
Premiumbeat.com